Hey everybody, welcome back to the Whiteboard Finance Show. Today's guest is Brian Feroldi, author of Why Does the Stock Market Go Up? I actually know Brian through Twitter, where he has roughly 280,000 followers. Welcome to the show, Brian.
Marco, thanks so much for having me.
Yeah, my pleasure. So you actually are now an author, I guess, if that's what I want to consider you. Has this always been a part of your life, or has writing always been part of your repertoire?
Yeah, I am not somebody that is naturally inclined to be a writer. I am actually a below average speller. My handwriting is terrible. So the idea that I would eventually become an author would be like completely laughable to me about 10 years ago. However, for the last 7 years, I've been a writer for the Motley Fool. So that has been the way that I've made my income for the last 7 years. And then about 2 years ago, I had the idea in my head for a book. And it was a book that I'd been thinking about for a long time. And it was more of a, why hasn't anybody ever tackled this subject before? Not like me saying, oh, I should go out and write a book. I was always like, why doesn't a book like this exist? And then about 2 years ago, after speaking with a couple of friends, Morgan Housel and Brian Stoffel, they kind of nudged me to think about actually writing a book. And when I considered it, I was like, all right, I guess I'm going to write a book. And then the book actually launched earlier this month.
Nice, very good. So that was kind of a loaded question because I had a feeling that you weren't, technically an author yet, but I knew of your background with Motley Fool. So how did you actually get started investing, or have you always been interested in finance, or is this just something more recent?
I think that I was like born to be an investor because in many ways, I was born to be a saver. I think some people just come out of the womb and they naturally have a penchant for saving. Some people are just naturally born to spend everything they make. And I've always been the type of person that enjoys saving a portion of my money and for whatever reason. However, I really didn't know anything about investing when I was younger or when I was growing up. My exposure to the stock market was very sporadic and it was here and there. And my dad actually invested in some penny stocks in like the late 1990s. So I do remember logging into like AOL, remember those days?
Yep.
And like checking the stock tickers for a couple of the ones that he bought, because if this stock goes above like some dollar amount, he was going to buy us dirt bikes. So I was like, please go up, please go up, please go up. It never got to the dirt bike price. But when I graduated from college in 2004, I knew very, very little about stocks or how the stock market worked or investing or compounding. And the sad thing is I say that as someone that graduated with a degree in business. So we studied plenty about business law and accounting and marketing and all those kind of things, but I never took a class in investing or how the stock market works or anything like that. However, upon graduation, my dad handed me a book called Rich Dad, Poor Dad, which I just devoured as soon as I got it. I was just immediately drawn to the concepts discussed in the book. And that just really kicked off a love affair that continues to this day, where I just want to learn everything I can about money, the stock market, investing, everything.
Yeah, Rich Dad, Poor Dad is an absolute classic. That's one of the first, I don't want to say investing books, because it's not necessarily an investing book. It's mostly just assets versus liabilities kind of a book. But
Yep.
once you understand that and shift that paradigm in your head, that's when it really starts the gears going of, real estate, stocks, different types of asset classes. So with, your book, what prompted you to start that? You said that there's nothing really out in the market that really talks about why the stock market goes up. What is the overall premise of the book, I guess is what I'm asking.
Yeah. So like many people like this, I started with Rich Dad, Poor Dad. And like you said, that book is almost about like accounting and money philosophy as opposed to anything else. And to me, that's the biggest takeaway that I got from the book. If you actually dive into its specific strategies about borrowing money and buying penny stocks and all that kind of stuff, if you just overlook that part and just focus on the core principles that are discussed, I think that they are timeless. And from there, I started reading every book that I can get my hands on about money. That included like the Motley Fool Investment Guide, Peter Lynch's One Up on Wall Street, The Intelligent Investor, biographies of Warren Buffett, Peter Lynch, Seth Klarman, et cetera. All wonderful books. Jack Bogle's wonderful books. And if you read it all about investing in the stock market, the books that I did, they all largely say the same thing. The stock market is a great place to put long-term wealth. You should expect lots of volatility along the way. But if you dollar cost average into either great individual businesses or just index funds in general, the odds of you doing very well and compounding your money at a high rate are exceedingly high. They all say that. And I kind of believed that. But the question that I had, despite reading all those books, was, all right, I understand that historically the market has gone up, right? You look at any chart of the S&P 500 and it's as clear as day what the long-term trend is. The thing that I never understood for myself was, well, why does that happen? Why is there this thing called the S&P 500 and why does it continually go up even though occasionally it crashes, right? I think intuitively people understand why the stock market goes down, because when that happens, there's usually something horrific going on in the world, right? 2020, the market crashed. COVID was like a brand new thing, and life just changed dramatically over a period of weeks. 2008, the financial crisis was kicking up. Banks were failing. People couldn't pay their mortgages. The unemployment rate was skyrocketing. It made complete sense to me why the market was tanking. 2000, there was the terrorist attacks and bad things were, and there was war. The wars were starting, and it was bad times. It made sense why the market was going down. I just didn't understand why the market went up in the first place. And more importantly, what was the thing that caused that would allow the market to recover from crashes? So I just always wondered, why isn't there a book out there that explains the very basics about the stock market, why it goes up, why it recovers from crashes, what the heck the stock market even is? So after wondering that for a long period of time, I finally set out to be like, well, maybe I should just write the book that explains it. So that's exactly what the goal of my book was. It's not like in-depth analysis on anything. It just explains what the stock market is, how it works, why it goes up over time, and why it recovers from crashes.
So if you had to summarize your book in like an elevator pitch, maybe 20, 30 seconds, how would you describe it?
Sure. Well, I think it's first important to say, start with what the heck a stock is. So many people just take that word for granted, that we know what a stock is, and then from there I scale it up to, okay, if you understand what a stock is, let's scale it up and say what the stock market is. And then once you understand what the stock market is, let's talk about what the S&P 500 is and the Dow is. And once you get that basic competency understood, I then talk about why a stock, an individual stock, goes up over time. Why is Apple worth, I don't even know, 1,000 times more today than it was 20 years ago? Why is Microsoft been such a good investment? Why has Starbucks been such a good investment? Once you understand that, then we just scale that very concept up to the entire market. And it's really that explanation that helped me to understand why the stock market goes up over time.
Absolutely. So when did you actually start investing? Because you mentioned that you graduated in 2004. Did you start investing shortly after, or was this when you started working at Motley Fool?
Yeah, I'll put investing in air quotes because yes, I started investing in 2004. I did start my 401k at the time. So I guess from that perspective, I did become an investor in 2004. Beyond that, though, I had no idea what I was doing when I first started. And like many people that had no idea what I was doing, I wanted the highest returns possible immediately. Like I didn't want to wait for them. I just wanted a 50% gain that week. If I was just starting today, I can guarantee you I would be on TikTok, I would be on Robinhood, I would be on the Reddit boards discussing what stock is going to go up 1,000% tomorrow. Right. That's what I was after. So at the time, the modern day version of that was penny stocks on Yahoo discussion forum. So I was out there looking for stocks that traded below $5 per share because I was only investing a few $100s. So of course, I have to buy stocks that are trading below $5 because then I can buy a lot of them. Right. This is bad logic of mine at the time. So I was buying terrible stocks. My only due diligence was share price. End of due diligence. Right. And my goal was to sell them later that month, that week, that whatever, for a higher price than I paid. Period. That's not really investing, but I was putting money into the market at the time. How's
Got it.
that?
Yeah, the reason I'm laughing and smiling is because I'm about 6 years younger than you, but I even remember those, the penny stock gurus that would come on, with the terrible ads. These ads were borderline hilarious at this point now. But if you remember some dudes, I'm not going to mention names, but I know exactly what you're describing when you mention the Yahoo chat groups and all that stuff. And it's almost like getting your, stock or investing information like in the locker room of a rec center. You know what I mean? It's like yeah, this is the next best thing. Trust me. So once you kind of, I don't want to say graduated, but once you evolved from, penny stocks into more, I don't want to say sophisticated or maybe more long-term outlook, when did that happen? And what was that transition from penny stocks to what?
Yeah, so I started with penny stocks. That was a complete disaster. Thankfully, I'm really thankful for that. By the way, I'm also really thankful that I wasn't starting today, because today it's never been easier to buy and sell, to get prices on your phone. And it's also never been easier to get options and leveraged products. And if I had access to those, boy, would those be dangerous at the time with that mindset. So I lost hundreds of dollars at the start. And while that's not a lot of money, today, boy, it felt horrible, right? So I have the mental scars from doing the wrong thing. So I started out with penny stocks. From there, I graduated to safe stocks, which were dividend stocks with yields of 10%, 15%, 20%. Because I figured, I'll just buy these. I'll just buy these, and I'll earn a guaranteed return of 20%. Like, that's okay, right? I'll wait a year for 20%. That also went horrifically bad, because then my only due diligence was dividend yield. Right? It's like making one mistake to the other. From there, I slowly started to learn that the share price of a stock doesn't actually matter, that the quality of the business is what matters. And in about 2008, I'd been a regular reader of Fool.com, which puts out, dozens of articles each day about investing. And I got my hands on a paid research report that they did on a company. And I remember reading that top to bottom and being like, these guys are so much more advanced investors than I did. Like, I was just blown away at the quality of the research they did on the business model, the financials, the long-term projections, the risks. Like, it was just so immediately clear to me that they were so far advanced, better investors than I was. From there, I became a paying member of the Motley Fool. And one of my favorite things about the Motley Fool is that they have these thriving discussion boards that are available to members. And these discussion boards are contributed by thousands of investors all over the world who are very willing to share their lessons that they've learned about investing, and very willing to share information with each other and challenge each other's ideas. And it's really from spending hours upon hours on those discussion boards with people that were actively trying to help each other that I learned a tremendous amount about investing. So that was really what kickstarted me to be the investor that I am today. And it's just been a slow, gradual process of learning that the way to invest successfully is what I do today, is buy high quality companies, own them for really long periods of time, and just accept that you're going to be wrong a whole lot along the way.
Absolutely. So it sounds like to me, are you mostly in individual stocks? Or are you kind of like a Bogleheads guy where you're investing in, broad-based index or ETFs? Kind of what's your breakdown? If you don't have to give specifics, with numbers and stuff, but what does your allocation look like between like individual stocks and maybe ETFs or index funds or whatever else you may be investing in?
Yep. So I am a huge fan of index funds. It's the number one thing I recommend to people that just started out investing or know very, very little. So all my retirement funds, all my wife's retirement funds,
multiple wives?
Index funds. Yeah, multiple wives. Yeah, my multiple wives' retirement funds are in index funds. Right. It's just like plain vanilla dollar cost averaging into index funds. Beyond that, all of my capital that is just in my regular brokerage account, that is essentially 100% in individual stocks. I am a big fan of researching companies, buying companies. I just love everything about the investing process. So with my non-tax advantaged capital, I am essentially 100% in individual stocks, and I own somewhere between 70 and 80, which sounds like a lot. However, if you look at my top 20 holdings, that's somewhere about 80% of the value of my my portfolio.
Got it. Yeah. So I'm actually in the process of recording. I have a video that went viral last year. It's called Stock Market for Beginners, and it has about 6 million views in about, I'd say, 13 or 14 months. And what I do is I just put out like a free hour-long course where I talk about exactly what you talked about earlier in this podcast, talking about what is a stock even, like what even does that mean? Then we talk about equity, dividends, things like that, so on and so forth. But the one thing that I wanted to mention was, you can allocate a certain portion of your portfolio in index funds and ETFs, but it also makes sense to understand all the different calculations that go into valuing a publicly traded company. So what are some of your metrics, or what are some of your detective work that goes into knowing what to put into that individual brokerage account that you mentioned?
You're talking from an allocation perspective, from a valuation perspective, from
I'm just saying, how do you
What?
analyze individual businesses and know Brian's going to buy this stock?
Sure. So this is the exact same thing. This is the exact process that I go through on our YouTube channel. So if I was starting from absolute no knowledge on a company, the very first thing that I would do is I would type in that company's name and investor relations. I would head over to that company's investor relations page, and I would just start reading. And the things that I want to answer for myself is, what is this company do? What is their business? What are their products? How are their products different from their competitors? What's their business model? How do they make money? Is it a recurring revenue business model, my favorite, or is it a one-time sales model? I ignore those companies. What are the margin profiles? What stage of development is it? Is it in the fast-growing, money-losing stage? Is it in the mature stage? Is it in the declining stage? Who's in charge? How much stock do they own? How long have they been there? Do I think that this company can raise prices? Has the stock beaten the market? Does the company exceed Wall Street's estimates? Are there any new products or services on the horizon that could hold long-term potential? What's it like to work there? I try and get a complete picture of everything that I can that's important to me about analyzing a business. From there, let's say it checks the majority of things that I look for in an investment. And I say checks because I have a checklist that I take every single company that I research through continuously to make sure I don't overlook any important steps. Let's say it scores very well on my investing checklist. The next thing I'll do is I'll check the market capitalization and just wonder how big is this company? Let's say I take a company through and it's a $5 billion business currently. One key question I ask myself is, okay, if this company succeeds, if it's successful, if it captures its market opportunity, how big do I think this company could be in, let's just say 10 years? And I want to believe that a company could be 10 times bigger in 10 years than it is today. So if a company's worth $5 billion today, I say, if this is successful, could this be a $50 billion company in time? There's no that's just more of a gut check than anything else to determine, okay, if I'm right, if I'm going to take a risk on this company and I'm right, can I earn a 10x return? If the answer is yes, and I like the business, I'll just open up a position essentially as soon as I can, as soon as I have capital to put into that. And I try my best to ignore the valuation of the company on my first purchase. The reason is if it is truly the next great growth stock, getting that stock into my portfolio is more important to me than getting it into my portfolio at the perfect price. And that's because the companies that are the true, in that true rare small percent of companies that go on to just dominate and grow like crazy, they tend to be called overvalued the entire way up. And it's a really big mental hurdle that I used to have where I focused very hard on the valuation. I was like, I only want to buy this company if it's trading at X times sales, X times earnings, X times free cash flow, whatever. And that caused me to pass, to not buy great businesses just because they were trading at bad valuations. I've since learned to kind of overcome that. So with my first purchase, I'm just going to buy if it checks all the boxes and everything and like that. I do record at the time of my first purchase the valuation that I paid. So I'll write down the price to sales ratio, the price to gross profit, the price to free cash flow, the price to earnings, whatever metrics are available to me at the time. Then I'll track that company's progress. If it's indeed exceeding expectations, or if it's doing really well, the business is doing well, I'm going to try and rebuy that company again. But this time, I'm going to try and pay a lower valuation than I paid with my first purchase. So if I first bought it at 15 times sales, I'm going to try and buy a second purchase at 12 times sales. And with each subsequent purchase, I'm trying to buy at a better and better valuation to lower the valuation paid with each future purchase. That's broadly my strategy. It doesn't always work out perfectly, but that's what I aim for.
Yeah, I love that, because I love the saying that, price is what you pay, value is what you get. So I come from, traditional financial background. I have a finance degree, and I'm like the old school Warren Buffett value investor. You're looking at PE ratios and stuff like that. Throw all that out into the garbage in 2022, right. Just because a lot of this stuff, which I wanted to talk about as well. I'm going to play kind of like devil's advocate here. Is you obviously have the book that talks about why stocks go up over time, but what are your thoughts on just monetary policy since basically 2007? We've seen QE 1, 2, 3, 4 infinity, which is just essentially money printing. What are your thoughts on stuff like that? Cheap debt. Big tech took advantage of that. You have all these tech companies that just absolutely exploded the past 10, 15 years. What are your thoughts on someone that's kind of like a gold bug, doom and gloom, hey, the market's just doing what it's doing because of essentially perverse monetary policy? What are your thoughts on that?
Yeah, essentially, as long as I've been paying attention to the market, money has been free. I mean, interest rates have been so extremely low since the 2008 financial crisis, and there's no doubt that has an impact on things like market valuations, like individual stock purchases. So it's folly to say that the macro and what the Federal Reserve is doing doesn't matter. Of course, it matters to investor psychology and to what's happened in the market. However, I don't really consider the macro much when I'm making an investment, or I'm always aware of the macro, but that doesn't really change anything that I do. The reason it doesn't change anything that I do is because of the way that I've structured my financial life. So my personal financial life is extremely conservative. I have zero debt to my name. I have a 6-month cash balance. We have multiple sources of income in our house. We have a high savings rate. For that reason, if the macro ever got really bad, or stocks got absolutely hammered, which they have been over the last couple of months, if you invest the way that I do, that literally has no impact on my day-to-day life, right? It hurts mentally to see the stocks that I own and love go down, but in no way does it impact anything about my life, because my personal finances are so hyper conservative. Because of that, that gives me the flexibility to essentially keep 100% of my investment capitals in equities, in stocks. And I can do that with taking on zero bonds, because any money that I put in there, I can leave in there for as long as I need be. In no way is it going to affect my personal life. So if the Federal Reserve does whatever, if geopolitically whatever happens, if inflation is high, I know that I want the bulk of my capital in the stock market, because that's the thing that beats inflation, that grows your wealth over long periods of time. And if stocks go down, I can take advantage of that by buying my favorite businesses at better and better prices over time. But more importantly, forecasting the macro is unbelievably challenging. And I know for myself, I've tried to make macro calls, at least in my head, over the last 10 years. And it's astounding how often I'm wrong. If you would ask me, what's the stock market going to do starting in February of 2020? I would have said, going down. Right? COVID was horrible, right? And I would have been like, we are going to be heading for minus 50%, minus 60%, another round of the 2008 financial crisis. And what happened? Stocks went parabolic. They just went straight up. And in 2017, I vividly remember this. In 2017, my portfolio hit an all-time high, and I was like, this valuations are crazy. Like, valuations are very high in 2017. I can't believe they're going to get any higher. If I made a macro call in my portfolio and sold out, went to cash, went to whatever, I would have missed like 100% upside, maybe even 200% upside from them. So I am no good at making macroeconomic calls or forecasting what's going to happen in the stock market next. So rather than try and do that successfully, I would rather structure my finances so I don't have to make macro calls.
I absolutely love that philosophy. And my wife and I, we share a similar philosophy. I always make the comparison of, when you're building a skyscraper, you got to dig deep and create a strong foundation, and then you can start building up. So, similar position as you, my wife and I, we have zero debt, like literally zero debt, no mortgage, no anything. And it allows you to be a little bit more risky in your investment profile, as opposed to where, heaven forbid, if we had a bunch of debt or a bunch of student loans or a bunch of consumer debt, and then you want to start gambling on, YOLO options calls and NFTs and butt floss coin and all this stuff, that's kind of the road to ruin, right? So I think once you have your financial house in order, then you can start, kind of rolling the dice a little bit, so to speak. But I love it. I love that philosophy because, I do follow macro trends. I don't have a crystal ball. No one does. Anyone that says they do is basically lying, in my opinion. But I think that I also had Brian Majuli, who you may know, or Nick Majuli, excuse me.
Nick Majuli.
Yeah, Nick. Sorry, for some reason I saw your name and I said Brian. Nick Majuli, and he also had a book that just came up that is a similar philosophy of just keep buying, right? So now, I feel like now is appropriate time to talk about some geopolitical concerns with everything that's going on, around the world with Russia and Ukraine and commodities prices going through the roof. With things like this, do events like this phase you at all, or is it kind of just that just keep buying, stock market goes up, mentality, if you will?
So it's much more the latter than it is the former. And so again, I pay attention to geopolitical stuff. I pay attention to the inflation rate. I look at what the Federal Reserve's going to do. I see what's happening in Ukraine right now, and I'm horrified, just like everybody else. I see what's happening with home prices, with gas prices, with food prices. I'm experiencing all those same things and paying attention to them, just like everybody else is. But I also know, well, what can I do as an individual investor to deal with those things? I really try and focus my time and energy on what actions I can take, not necessarily what's happening to me. So when I still back up and think to myself, all right, given all the chaos that's happening in the world right now with inflation, what are my options as an investor? Well, I'm still going to keep my personal finances extremely conservative. I'm still going to keep a 3 to 6 month cash reserve just for buffering against my life. Yes, I know that the value of my cash reserve is the purchasing power is rapidly dwindling, but that's not the point. The whole point of that is to protect me in case something drastic happens in my real life. So I know that the value of that cash is going down. That's just the cost of having that kind of buffer in my life. But moreover, long term, what do I think is the best way to grow my wealth over time and to protect myself from inflation? For me, the answer is the stock market, right? It's investing in high quality businesses that can raise prices, that can go after a market and are producing compounding amounts of free cash flow. That's where I want the bulk of my capital in. And I just accept that over short periods of time, sometimes the best investment is gold or commodities or oil or real estate or whatever. And occasionally stocks are going to be the worst place to be. But I still think that over long periods of time, the stock market is where I want the vast majority of my capital. So I don't plan on making any changes to that.
Yeah, I love that. I feel like I talk a lot about this a lot on this channel is, the average person should care about the stock market because I have a ton of videos going back years now talking about how savers are losers. So when we're sitting at ZIRP, zero interest rate policy, and people are getting 0.4% interest in their savings accounts, and inflation is now at, I believe, 8.5% year over year, at least CPI is. True inflation is probably closer to 12, 15% for average middle class people. Savers truly are losing their purchasing power, which is why I tell everyone to be invested in something, right? Whether it's stocks, commodities, real estate, oil, whatever. Why should the average person care about the stock market? Or did I kind of steal your thunder by saying all that already?
No, that's perfectly fine. I think this is a very important question because before I studied the investment, the stock market, before it was even part of my sphere of knowledge, the only thing I knew about the stock market is it did this. Right, it went up and down. All I knew it was a number that was spoken on the news, reported in the paper, and it just randomly went up sometimes, and it just randomly went down sometimes. And it's really hard to get people that don't care about investing or don't care about the stock market to care about it. And it's a perfectly valid question to say, why should I even care about it? Why should I pay attention to it? For me, the answer there is that the stock market is the greatest wealth creation machine that's ever been created. The stock market literally enables ordinary people with ordinary incomes to make themselves into multi-millionaires with essentially, I'm not going to say no work, but very little work and very little thought and thinking. If you just dollar cost average a portion of your paycheck into the US stock market and then do that continually for a few decades, I'm extremely confident that 2 decades from now, 3 decades from now, 4 decades from now, you're gonna end up a multi-millionaire. And that is something that is within everybody's ability and grasp today, almost regardless of your income. Trading costs have come down so much, and there's so many tools available to this that you can do that very easily. So if you care about building your wealth, if you care about growing wealthy, which you should, because like it or not, money affects so many aspects of our life. It affects where you live, what kind of food you can eat, what kind of life experiences you can have, where your kids go to school, the healthcare you can access. All of that stuff costs money. So if you care about improving your and your family's life circumstances, you should care about money. And if you care about money, you should care about the stock market.
Absolutely. Yeah, I agree wholeheartedly. And also how much you can give back as well, whether it's legacy building, whether it's, creating a park in your community, just small examples like that. You do that through money. I mean, yes, you can work hard your entire life, but, let's be honest, money is almost like, they're freedom units, first of all. That's the way I look at money. They're just freedom units for myself. And then secondly, it's, power. It's not power from like a evil dictator sense, but it's power from a ability to affect other people's lives, positively. If you want to start a scholarship fund at your church or whatever, you're able to do that if you have money. But if you don't have, any freedom units or a pot to pee in, you can't really be that influential, let's be honest. So here's a perfect example. I had this question ready for you because I know the premise of your book. Before I get into this story, the question that I'm going to ask you is, how do investors determine what a business is worth? Because what I'm seeing a lot here, you mentioned it earlier in the call or in the podcast, is, I'm not on, I wasn't on TikTok 20 years ago. I wasn't on, Robinhood or trading options or any of this stuff simply because it didn't it exist. But I was at the Cavs game against the Hawks on Friday, and my buddy comes up to me. We're in this lounge, and he's like, "Oh, dude, haven't seen you in a long time. I'm down X amount of dollars in my Robinhood account. I'm not going to say what it is, but it was a very big number." And he's like, "Dude, I sell cars for a living. I have no idea what I'm doing. Like, I'm just clicking buttons, right?" So how do people go from, "Hey, I read about this investment on a subreddit, Wall Street Bets, or I heard it in the locker room of my rec center," to actually understanding and determining what a business is worth? Does that go back to your valuations and your multiples, or how are you evaluating these businesses now?
Yeah. So first off, for your friend there, right? My favorite thing about investing in stock market and index funds is you don't need to know what a business is worth in order to do well with the markets,
True.
right? All you need to do is dollar cost average into index funds. Period. End of story. That's what you need to do.
Yeah. Sorry to interrupt, Brian. I literally told him, like, dude, just buy VTI and like thank me in 20 years. Like, stop doing this. He's literally clicking buttons. I'm just like, oh my God.
However, on the flip side, if Robinhood took your friend and made him from "I don't care about the markets" to "now I'm paying attention, now I'm interested in learning," that is a service in and of itself, right? Robinhood, for all of its flaws, and Wall Street Bets, for all of its flaws, has taken millions of people that had no clue about the market and has taught them to pay attention, right? So that in and of itself is a win. Now, they're not investing, quote unquote, the right way, the way that we would suggest they do so, but at least it is getting them in the game and paying attention to it. But to answer your question there, so many people have no idea what stocks are. So many people just think of them as something on their iPhone that just goes up and down, and the whole goal is buy low and sell high. That's what everyone's trying to do, right? Buy low and sell high. But I don't think many people, especially new people, know even what a stock is. They don't know why it has value. And if you don't know why it has value, you certainly don't know how investors are valuing it. It just looks like something that's being traded back and forth. And again, the whole goal is to buy low and sell high that day, that week, that year, whatever your time horizon is. So for people like that, I would literally ask them to start with just like the very basics, like what is a stock? Why do stocks exist? What does a stock represent? And how do you value them? That's one of the trickiest questions about investing. I mean, the classic textbook answer to that question is a stock is the value of the present value of all that company's cash flows in perpetuity, right? This is why discounted cash flow models are popular with many investors, especially value investors. That's one way that you can invest in value businesses, and that's the correct way to do so. Personally, I don't use discounted cash flow models at all, simply because I think it's just using fancy math to make a guess, right? And you can make a guess with unfancy math. And I think with discounted cash flows, it's really easy to fool yourself into getting an exact answer that is guaranteed to be wrong. Like you're predicting the future with high degrees of accuracy. And I think DCF models actually increase your confidence in yourself more so than you increase the actual accuracy of a prediction that you're making. However, they do have value, and some people do use them. When I'm thinking about the valuation of a business, I always go to the very simple valuation metrics that are available to us. My absolute favorite is price to earnings ratio. When it works, the problem is there's a whole bunch of businesses out there where the price to earnings ratio is useless. It's completely useless on many businesses.
Especially tech companies. Sorry to interrupt, Brian. Mostly tech companies as well.
Yep, on both sides of it. It can be very misleading on the way up because the PE ratio is dramatically understates a company's earnings, and also on the flip side, a PE ratio on companies like Hewlett Packard, IBM, companies that are in the declining phase of their lifetime, it can be very misleading on that end too, because these companies are so cheap. Well, if earnings are heading towards zero, it doesn't matter what multiple you pay today, you're going to lose money on them. So the PE ratio is my favorite. But you have to know when it works and when it doesn't work. Beyond there, I just go up the income statement. So after a price to earnings ratio, I'll look at price to operating income. If that doesn't work, I look at price to gross profit. If that doesn't work, I'll look at price to sales. If that doesn't work, I'll look at price to free cash flow. So every business is kind of unique in what metric to look at, or at least what metric hints at a company's valuation. But valuation is one of the hardest things to figure out about investing, to say nothing of how hard it is to value dynamic, fast-growing businesses.
Yeah, I love how you said how hard it is to invest, or something along those lines. It sounds to me that you're managing, multiple stocks. You have, money invested with your, wives, IRAs or 401ks. Do people even need, and sorry if this wasn't the most smoothest transition, do people even need a financial advisor in this day and age?
So I would say it's like anything, it depends. My first question to people about should they use a financial advisor is, would you do this on your own? Would you do this on your own? Would you or your wife or your significant other pay attention to the market, be willing to learn, be willing to get set up a 401k, to set up an IRA, be willing to put capital into the markets? If all that stuff, if you are willing to do that on your own, you don't need a financial advisor. However, if you're unwilling to do any of that, or you just want a second opinion, or you just want somebody to talk to, I think there is value with having a financial advisor. The way I equate it to myself is I do yoga. Okay. I go to a studio to do yoga. I don't go there to do the moves. Like all the moves you can look up on YouTube in 2 seconds. I go there to be a part of a community, to have somebody else managing it. And I know that by going there and being part of them, I'll actually do it. If it's just me doing it on my own, I can say to myself, I'll put this off for essentially perpetuity. And I need a third party holding me accountable to make sure I actually do it. I view a financial advisor in many ways the same way. If you have the discipline to invest and handle your money on your own, great. You don't need a financial advisor. If you don't, they can add a lot of value.
I love it. I love that analogy, because the analogy that I always use is a financial advisor is like a personal trainer. If you already have the discipline and you know what workouts to do, you don't need a personal trainer. If you need someone to kind of handhold you or to go to the quote unquote yoga studio, I completely agree. I think they're necessary, but if you have the discipline and the knowledge, you can do it yourself. And it really is easy in this day and age. In 2022, I feel like most anyone, all they need to read is the Boglehead's Guide to Investing, open up, a Roth IRA, a 401k, and you're good, right? For the most part. I think financial advisors are very useful once you start getting into multi-generational planning and, very wealthy individuals and estate planning and things like that. I think they can definitely have their core components there. But I think for most middle-class people, if you have the discipline and the know-how, I don't really think they're necessary, but that's just my opinion.
Like so many things about money and investing, the quote-unquote right decision is always personal, right? Some investments are right for some people. They're not right for others. Working with a financial advisor is right for some people. It's not worth it forever. Everything about money and investing is personal.
Love it. So it sounds like to me a lot of your net worth right now is sitting, most likely in equities. I'm just guessing. I don't know your net worth or your, what you're invested in exactly. But what are your thoughts on some alternative investments, such as maybe real estate, maybe precious metals, maybe crypto or Bitcoin specifically?
Yep. So I know for myself that I have no interest in commodities. Commodities can be great investments over short periods of time, like we're going through now. Commodities might be a great place to be over the next 5 years. I don't know, but commodities don't produce cash flow. If they don't produce cash flow, I have no interest in owning them. As far as real estate, I think it makes sense if you're going to be investing in REITs. I own my personal residence. That's my real estate exposure personally, and I know people that do very well with real estate, buying properties, leasing them, renting them, fixing them out. Real estate's a great asset class. It's just not one that interests me personally beyond REITs. So that's real estate. Crypto, I was very skeptical of for a really long period of time. I will say over the last year or two, my thoughts on crypto have evolved as I've educated myself more about it. I used to be like, nope, this is something that's just completely speculative, avoid it altogether. However, in the last year, I asked myself actually a really interesting question, which was, should there be a global currency of the internet? Should there be? I think the answer is yes. The more I think about it, the more I think the answer is yes. If the answer is yes, what is the leading contender to be that thing right now? The answer is Bitcoin. So because of that, I see nothing wrong with putting a small portion of your portfolio into Bitcoin and Ethereum. I've done that with my portfolio, very small. I do plan on increasing that over time, but I'm also positioning. So if it goes to zero, if it's completely wrong, if this is just a Ponzi scheme that flames out, I'm going to be perfectly fine financially. So those are the assets that I'm highly focused on basically two things. One, stocks, and then two, cash, just between the two. And then I have a little bit of real estate, but that's my entire investing portfolio.
Yeah, I love how you said that, because I feel like every investor should allocate a certain portion to, let's just say, speculative investments, and they should allocate up to how much they are comfortable losing. So if that's 5% of their net worth and it goes to zero, no big deal, right? If it's 90% of your net worth, then you have a problem. So I think that as long as you allocate accordingly, and I think you and I just, from this conversation are probably more on the conservative side of things, I still think that personal finance is number one. And then once that is taken care of, your house is in financial order, then you can kind of go gung-ho in, other types of investments. So what are some of your high conviction, I don't know if you want this to go on the record or whatever, I can edit this out, but what are some of your high conviction bets or high conviction stocks that you're investing at this point?
Sure. So I like I said, I own about 70 stocks or so. My broad strategy is to make lots and lots and lots of bets. I put my money into high conviction, high quality businesses. I buy them. I own them with the mindset that I'm going to be wrong a whole lot. Like I know if I buy 10 stocks that I'm going to lose money on 4 of them. I'm going to make a little bit of money, but less than I would on the index on another 3. I'm going to outperform the index on 2 of them by a little bit. And then one of them is going to be a mega winner. And that one mega winner is essentially all that matters. All that matters.
Yep.
My portfolio today, because that's what my adopted mindset is, it's very concentrated into my biggest winners of all time, simply which were companies that I bought and have held for a long period. So my number 1 position today is Tesla. That's not how I designed it, right? I just happened to buy Tesla literally 10 years ago and haven't sold it. And it's up so much that it gradually earned its spot as the number 1 position in my portfolio. Another one is my number 2 position is called Mercado Libre, which is like the Amazon / eBay / PayPal of Latin America. Mm-hmm. Another one, I never would have predicted that it was going to become my number 2 holding, but the stock is up so much since I bought it that it's grown to be my number 2 holding. And then my number 3s through 10 are kind of many of the FANG stocks. Facebook has been a mega winner for me. Netflix has been a mega winner for me. Google has been a mega winner for me. So those are my conviction is simply because that's where my portfolio has gone into. Beyond that, what I'm always trying to do is kind of find the next crop of high growth companies, and I'm constantly feeding small amounts of capital into companies that I think have 10x plus potential.
Where do you think that is now? Is that the metaverse, or where do you think that is now?
The metaverse is one spot to look. My favorite areas are small, fast-growing tech companies and small, fast-growing medical device companies. Those are companies that if you find them early, they tend to have high growth, high margins, and customer lock-in in some way, competitive advantages. But again, I buy them knowing that I'm going to be wrong a whole lot on them. So if you want to check out the ones that I own, my portfolio is freely available to look at on the Motley Fool. One of my favorite things about the Motley Fool is everybody that works there has to disclose all of their holdings at all times. Mm-hmm. So my portfolio, all the stocks that I own can be viewed on my portfolio, on my profile page. So hopefully some of tomorrow's mega winners are in there.
Love it. Okay, so we're coming kind of towards the tail end of this podcast. If you can leave, a nugget of information to anyone, whether it's the average investor, whether it's, just the average viewer of this channel, it's basically people that are anywhere from in their 20s to maybe 40s or 50s trying to learn about how to invest, properly or invest better or build their wealth. What are some nuggets of information? It could be a book, it could be a movie, it could be a documentary, anything. What would you recommend?
Sure. So my general philosophy to those people is that the number 1 thing when it comes to investing successfully is to adopt a long-term mindset, to get your mindset truly correct. I could tell you today what the next great stock is. Like, let's say I knew what the next great stock is. If you bought it today with the wrong mindset, you're going to lose money on literally the greatest stock over the next 10 or 20 years. Because if you're buying, if you're investing and you adopt it with the wrong mindset, you're going to buy that stock high when it falls, which every stock does, the good ones and the bad ones. You're going to sell it when you're at the bottom. So this is why the critical piece to start with is to adopt a long-term mindset. All of the gains that come from investing in the stock market are due to the nature of long-term compounding. And the way that compounding works is the big payoffs happen 10 years from now, 20 years from now, and 30 years from now. So if you don't start with that base premise that I'm going to adopt with a long-term mindset, I don't think you're going to do very well.
I love that. I absolutely love that. I feel like I had so many consulting calls in March of 2020 when the market, took a crap, and people are like, should I sell everything? What should I do? I'm down 30, 40, 50%. I'm like, absolutely not. Like, whatever you do not sell that off. And I always ask them the question, why did you start investing in the first place? Are you just gambling? Are you clicking buttons? Are you actually understanding what you're buying? And then once they start asking themselves that question, you saw what happened after March of 2020. It was just, almost a hockey stick in growth. But I absolutely love that. I absolutely love that. I think your mentality, I don't want to say is like the right one, but I feel like if you're looking at a number of different stocks, let's say, you pick 10, right? And you already go into it with the expectation that, hey, 4 to 5 of these may be duds, a couple of these may be, average, below average. One of these may be a unicorn, a couple may be a good winner. I think that that's a good way to cast a broad net and allow people to invest in individual stocks. And then also, obviously, index funds and ETFs are kind of what I'm a proponent of for the average investor. But I think that what I kind of wanted to leave, I wanted to ask this earlier in the podcast, if you don't mind disclosing, what have been your biggest winners and your biggest losers? And we'll kind of end the podcast on that note. If you want to disclose that, you don't have to.
Sure. I mentioned them previously. My biggest winners of all time have been Tesla, Mercado Libre, Netflix, Amazon, MasterCard, Google, Facebook. Those are the ones that I bought and I held, and they have just gone up tremendously. Mm-hmm. When it comes to my biggest losers, we're going to need a whole other podcast for that, because I have bought a lot of stocks or a lot of businesses that I was very high conviction on, and I was dead wrong for one reason or the other, and they went down.
I guess sorry to interrupt. I guess a better question would be, because going in with that philosophy that half your trades are probably going to be losers, I shouldn't have asked it that way. I guess what were some of your what were some of your highest conviction? This one is going to be a unicorn for sure. It's going to be 10x, 10 bagger, and it just was a dud. If you have an example of that, that would be great.
Oh, yeah. So back in 2013, 3D printing stocks were all the rage. There was companies like 3D Systems, like Stratasys, like X1, Proto Labs. These companies were the next generation. They're brand new technology called 3D printing, and each of them, their revenue was growing. It was like, these things are going to replace Amazon. We don't need Amazon anymore, right? We just got to have a 3D printer at our house, and we can 3D print whatever we want. And I totally got caught up in the hype cycle around those businesses. And if you look at what happened to their stocks in 2012, 2013, they just went straight up. Each of them was a multi-bagger at some point. However, you probably noticed that people still use Amazon, still shop at Walmart. We don't all have 3D printers in our house printing out everything that we need. So I lost 50%, 60%, 70% on many of the investments that I made in those companies simply because I got caught up in the hype. However, what I was going to say previously is the best thing about investing is that if you take every single loser that I've ever had, every single one, and you add up all the losses that I've had, boy, would that make me feel sick to do so. But all of my losers combined are dwarfed by the gains that I've had on just my one biggest winner of all time. This is how investing works. This is how investing in the stock market works. You can buy 10 stocks, do terribly on 9 of them, but if that 10th one is the next mega winner, your nine losers don't matter. It's that mega winner that drives your entire portfolio return. And the funny thing about that is that's how the entire stock market works. The S&P 500, the VTI, the entire stock market, the entire returns of that are driven by a small minority of companies. That small minority of companies literally provide 100% of the returns of the market over periods of time. However, if you're buying an index fund, that's invisible to you. All you see is one thing going up. You don't see the fact that 70% of the stocks that you hold are going down or underperforming the index. All you see is the index going up. Mm-hmm. That's the exact same way that investing in individual stock works, except for you get to see that thing happen in real time. And
this is similar philosophy to a lot of Silicon Valley VCs. I mean, they have hundreds of losers, but the one unicorn they win on just absolutely dwarfs their losses, just like you said. So I love it. Brian, thank you so much for coming on to the podcast. Where can people learn more about you?
Thanks so much, Margo. This is an absolute blast. You can connect with me on Twitter. I'm at Brian Feroldi. If you're interested in learning how I pick individual stocks and research them, as you asked me before, that's what I do on my YouTube channel, which is my name, Brian Feroldi.
Love it. Love it so much. And go follow Brian on Twitter as well. Thank you, Brian. Appreciate you coming on.
Thank you, Marco.
You're welcome.
Thank you for listening to the Whiteboard Finance Show. To read more about today's episode, visit whiteboardfinance.com. And don't forget to subscribe to Whiteboard Finance on YouTube. This show is for entertainment purposes only. Investing of any kind involves risk. While it is possible to minimize your risk, your investments are solely your responsibility. This show is copyrighted by Zlatic Media LLC. Written permissions must be granted before syndication or broadcasting.